Guys, today we're just going to do a reaction video, and we're going to watch David Rosenberg talking about inflation, the Fed, and bonds, and then also get a different perspective from Tom Lee, focused more on small caps. But they're both kind of talking the same lingo, and I think the perspectives are good and unique, and I wanted to share them. So, and then I'll give my commentary along the way. Here we go.
When it comes to the interest rate path, our next guest says the Fed is far too wed to CPI, needs to take a more holistic approach to inflation, predicting we'll still see easing in the second half of the year, and finding value in both bonds and precious metals. Let's bring in Rosenberg Research founder and president, David Rosenberg. It's good to have you back on, David. You know, the bond trade, that has not worked in your favor. It's been selling bonds with higher yields, persistently higher on these upside inflation surprises and pushing out Fed cuts.
Well, it hasn't worked for the past few months, and I wouldn't say it's so much because of the CPI data as much as the pivot from the Fed. The most important determinant of yields of the Treasury curve is expectations of Fed policy. So, you know, when we went from 5% at the peak last summer down to 3.6, you know, we've gone from a period where people thought there was going to be endless Fed tightening to the Fed cutting rates 4 times this year. And then we backed up, you know, from 360 to say, 460. And that's because we've gone from pricing in 4 rate cuts to practically nothing. So the bond market is just following this ongoing, you know, shift in the Fed's ongoing pivoting. So that's really what the story has been.
But isn't the Fed pivoting because the inflation numbers have come in a little hotter?
Well, you know, that's what they say. You know, the CPI number is not what they forecast. It is a completely flawed statistic. And for all the talk about there being broad-based inflation, it's really down to 3 things: auto insurance, health premiums, and the way the BLS treats rents.
All right, I just want to pause there real quick. So I've been saying this for a while. A lot of people look at Supercore and other stuff. What he's saying is, you know, health insurance premiums, the way the BLS handles these rents, all these things are leading to numbers that are showing higher levels of inflation that aren't necessarily reflective of what's happening underneath in the economy. And again, I'm just going to say, I reiterate this like all the time. China is deflationary towards the world. The only thing that's really going to slow that down is massive levels of tariffs, because they are dropping costs on everything because they've got oversupply and they're trying to crush Western markets while at the same time just trying to keep their system flowing. So it's going to be incredibly deflationary, but let's listen to what the rest of David has to say.
PC deflator has been much more tame. And the point I'm making is that when you read the Fed's Beige Book, which has been around for 53 years, and Sarah, if you read the entire Beige Book, you're scratching your head. Where is the inflation? The inflation is in the way the BLS constructs the Consumer Price Index. But all you read about in the Beige Book, and it's the Fed's own survey. These are the Fed's own business contacts, and they were saying it was just replete with evidence that the corporate sector is losing pricing power. So whatever inflation you're talking about is showing up in margins. It's really not showing up in final inflation.
It's what you guys have to listen to. This guy, David Rosenberg, is so smart. He's spot on. Let's listen to what the rest he has to say, but just please take your time, rewatch this if you have to.
It's showing up in services inflation too, though, David. I mean, we see that in the numbers, and the story, I guess, that they're worried about there is just that the economy is still very strong. We're expecting this first quarter GDP number on Thursday. It's set to be above 2%, driven by consumption. And as long as that's going strong, unemployment rate is still below 4%, and inflation is running a little hotter, then there's no rush to cut rates.
Sarah, I totally and respectfully disagree with you, okay? The services that you're referring to are rents and being influenced by the distributive lags that are keeping the disinflation process and rents painfully slow. Insurance premiums, what does that have to do with the economy? What does that have to, I mean, health insurance premiums, what does that have to do with the economy? If you're taking a look, for example, at airfares, they're deflating. Accommodation rates, they're deflating. Inflation.
Health insurance, car insurance, taxes going up. There's a lot of stuff that is making inflation look really hotter than it is, and also suppressing consumer spending power, which will, guess what, lower inflation too. And then you have China exporting deflation.
In restaurants has slowed down dramatically. So I would take issue that the service sector inflation is something that the Fed can really even combat. But the cyclical part of services even is either slowing down or actually deflating. As for the economy, yes, GDP is about aggregate demand. You can't forecast inflation with one curve. You need demand, you need supply. So you said before, yes, real GDP 2%, 2% plus. What is the aggregate supply curve doing? Productivity and labor force growth collectively are running 3.5%. You can't forecast inflation with one curve. If you're taking a look at how the supply curve is moving in relation to demand, the pressures on inflation, with all due difference to the BLS measurement of the CPI, when you're taking a look at how the supply and demand curves in the U.S. economy are shifting over time, it is in a disinflationary pattern.
He is just so smart. You cannot determine the path of inflation or disinflation, whatever, without looking at supply and demand curves and seeing the balance between them. Very few people talk about this. Just keep listening. You'll learn something.
David, we were already getting some stories about Bernanke and Brookings looking at the BOE's forecasting model. I wonder if you think their attention or others' attention starts to turn to the Fed's model as well.
Well, frankly, I don't even know what the Fed's model is. I think that the central banks are, as a group, thinking about how they dramatically miss transitory. And I think that we know the reasons for that. I don't even think so much the models. It was that we got hit with multiple supply shocks all at the same time, that we were getting a huge demand increase from not just the reopening of the economy, which was earlier than expected. Who thought a vaccine was going to come this quickly? But also the fact that we had, the massive fiscal stimulus. The inflation, I think that the central banks are overreacting. We had an 18-month inflation bulge. Yep. This was not the 1970s all over again. 18 months. And inflation, like everything else, doesn't move in a straight line. So you could argue, well, we've had a couple of months of a CPI, not totally reflected. I mean, did you see any inflation in the PPI number that came out a couple of weeks ago? It's interesting that the consumption components, which include services in the PPI, nobody talks about it. No. Look, nothing.
Yeah, that's a very good point. People are talking about CPI. They're not talking about PPI. I think some of the data that we're going to get out on the PCE later this week will show weakness too. But again, I think people are all too excited to think that inflation is reoccurring again and leaning towards there's going to be no rate cuts. And there's so many reasons why there's going to be rate cuts. In today's market recap, I'm going to be posting a couple of charts that will reflect why the Fed has to lower rates this year, and why I believe that they're going to be doing that towards the middle of the year. But I'll save that for then. Let's listen to the rest of what David has to say.
Like the CPI number. But the point I'm trying to make is that, the supply-demand curves are shifting in a way that, to me, leaves me still bullish. I am buying bonds on price dips. We're talking about the central banks. I think that collectively, even you look at the Bank of Canada, where they even talked about how the economy in Canada has moved into excess supply, they're still like deer in the headlights. They're still living in yesterday's story, which is that 18-month period of inflation. Now, we've had a couple of idiosyncratic reports in the CPI numbers. Look at the gap between CPI and PC deflator. And I think the central banks are overreacting. And I think that what I wish is that the Fed would talk more about the supply-demand framework. You see, the thing is that Powell talked about this last December, and I was very impressed that he talked about demand and supply and talked about how the supply growth was overwhelming even the 2% plus demand growth we were seeing. And I thought, well, that's an elegant framework because you need two curves to forecast inflation. But I don't know if the Fed is really publicly, they're expressing concern about the CPI, but maybe behind closed doors, they're really concerned about where the inflation has really been, which has been in asset inflation. But they're not going to talk about irrational exuberance publicly, because when Alan Greenspan did that in 1996, he got pasted by the business media for doing that. So maybe it's all cover for what they want, which is asset inflation to come down to more reasonable levels.
Interesting theory. David, it's always good to go back and forth with you. Thank you for coming on. Really appreciate it.
All the best. Take care.
David Rosenberg of Rosenberg Research.
All right, David's brilliant. So we got his perspective, and his perspective was rates need to come down. People aren't paying attention to PPI. They're not paying attention to the PCI deflator, and that the Fed knows that they need to do this. They know that rates need to come down. If nothing else, they're purposely just trying to bring down asset inflation by talking it down when they know what they're going to have to do. And again, I'll back some of that up in the market recap here this afternoon at 3 o'clock. Let's go ahead and listen to Tom Lee now. And what do we got in chat here? Manjinder, hi from Scotland. Still raining here, like probably a lot, right? Got to stay positive, though. Tomorrow might be sunny. Good luck, man. I hope so. All right, let's listen to Tom Lee here, guys. Might go back just a little bit, get to the intro here. Yeah, there we go. All right.
There are some reasons that you think maybe we're nearing the end of whatever you want to call this, this tough period for the past 2 weeks.
Yeah, it's been a painful 2 weeks. I think some of the ways to think about why we're near an end is inflation expectations have way overshot to the upside. You know, 1 year forward inflation is at 4.5%. It's where it was in October 2022, March 23, October 2023. So at the peak pessimism.
That's one thing.
Yeah, short interest has soared. Like 1 week, Goldman shows 1 week short interest in ETFs rose by the most since 2022. Median short interest in stocks is at basically a 3-year high. We're really oversold. If you look at internal measures like the percentage of stocks over their 20-day moving average, it's down to 8%. Again, a turning point. And now we just need a positive catalyst. I think as long as inflation tracks better than expected, I think we're in a good position to rally.
You look at different things in Katie Stockton, obviously. She said that there has been some damage, therefore she thinks there's maybe some more work. Not a whole.
Yeah, I didn't catch who she was, but there's been no technical damage done to the NASDAQ, the S&P, the Russell, none of it. It's all very much in line with what would happen in markets if you have a strong bull run and you look to retrace so that people can re-enter again. And again, it's about catch up, right? There's people, as we go higher, people will say, oh, yeah, it's still not going to happen. I don't believe it. And then it will retrace 10, 15%, and they'll put some of their money in the markets. And then it will go higher, and they'll be like, oh, I'm still not sure. And then it'll drop even more, and then they'll be like, they'll get in even more. This is how markets work. I see nothing right now that's going to keep the markets down. If anything, I strongly believe that we're going to melt up before we have any kind of meltdown. It's just how markets work. We haven't hit irrational exuberance. Right now, even the IPO market and like private, all that stuff is starting to kick in, and we're seeing markets open up, and we're seeing people become risk on. And this perfectly aligns with the Bitcoin cycle. It perfectly aligns with Tom Lee's thesis on what's going to happen with small caps, which haven't really done anything in a decade. So again, let's let him speak here, though.
A whole lot more work, but maybe some more. Do you look at that? Has there been some damage, or do you see all positive indicators as far as maybe we're getting close to the end of the beginning of the end, end of the beginning?
Yeah, I think probabilities probably is what she's looking at, and I think there has been a lot of damage to the markets, but there are ways to look at why things could be turning. Mark Newton, our head of technical strategy, says the cycle turn date he was looking for is April 20th, and that's
420.
Yeah, 420.
Perfect.
And if you look at things like the DeMark count, we're at almost a 7, so we're only 1 or 2 days from a potential bottom or turning.
So yeah, this must have been like, I think this was this morning, this interview with him actually today, and they said that they were expecting the market bottom to occur on 420 and that it might be happening in the next couple of days. I don't know if you guys have looked at markets today. MicroStrategy up 13.6%, CleanSpark up 7.5%. Cypher up 13.67, Robinhood up 3.64, SoFi up 2%, ArcG up 2.4%, PayPal up almost 2%. Markets are bouncing now, and I called this on Friday and over the weekend. They're technically oversold. There's no real damage here. If they start bouncing, and we're seeing some bouncing, and we're seeing them get into support ranges where they could hold on and go higher. And if anything, technically, it looks good.
Point.
And we're oversold. We actually got oversold really quickly.
Yeah.
I don't know why.
Well, they say bull markets rise in an escalator, fall in an elevator. So it's what you'd expect in a rising trend is sharp corrections, and it shakes people out. And I think there's a lot of top callers, but to me, I think this is a good opportunity.
So also the day before 420, did you know 42024 is frontwards and backwards?
Oh, it's a palindrome number?
Certainly is. But the day before was the halving. And what does that mean to you for your Bitcoin projection?
It's a reminder of the sound money of Bitcoin, right? Because it's pre-programmed every 210,000 blocks to cut the block reward. We know it means you're cutting supply, but demand has been strong, and actually Bitcoin network usage has really been strong because of things like Rune Protocol. So you've kind of made the demand side stronger and the supply side smaller, so I think it's upward pressure on price.
So you always have crazy forecasts. What's your forecast now? And I'm doing something while you're doing it.
Yeah,
What's your forecast?
well, I think Bitcoin definitely makes new all-time highs this year, so we think something like 150,000 is probable this year.
I actually agree with that. I think the bare minimum would be 92,000 if we really fuck it up, and then it's 149-ish is the next fib level. That would be a good retracement zone. And then whatever happens into next year, my target right now is 280,000.
Year. And then longer term, I don't think there's anything wrong with those targets people have, like 500,000 for Bitcoin or.
Yeah, so remember, I'm conservative at 280,000. There's a lot of people that are in the 3s, the 4s, and the 5s, and that could happen.
Or much higher.
I was opening this for Andrew because first thing I read this morning was up the dirty money flying under the billions. And I kept looking for the B word. And it's just not anywhere here. Not one thing about Bitcoin being used for the money laundering. So it can be done without Bitcoin, I guess.
Yes, I think that money launderers have successfully used other currencies
Since the beginning of time.
for many years.
We always point that out,
And
right?
commodities, collectibles.
I think it is good. I mean, ransomware is always Bitcoin, and that is the nastiest kind of I think, extortion. So, I mean, there can be some uses, but you can use cash, right?
And use cash.
Did you see that?
Possible.
You saw
I
that.
did see
Did
the
you think
article.
about me? I thought about you when I read that.
When we come.
All right, let's kill it there. So yeah, I'll be talking more in the market recap and going over everything that we've heard, along with a bunch of other charts that I think will be insightful. I honestly, though, I get fired up listening to David Rosenberg. He's looking at it from the bond front and the fact that, rates will start to go down and bond values will go up. I don't love especially long-dated bonds. I don't think that that's going to be a good opportunity with how bad the government is managing their debt loads right now. Shorter dated might be okay. But so I don't totally agree with David on that front. But I do agree with him on the fact that the Fed has to cut. And again, I'll be showing you some charts on why that's going to be on top of everything I've shown you already. And I agree with Tom Lee about the fact that markets are going to start taking off. And I think, if anything, again, I still think we're broadening. I still think that the small caps will do well. I still think that we're going to see a lot of good big tech earnings. What happens with Tesla tomorrow? I don't totally know. Everybody, every time I post something about buying Tesla, people are like, "You're so dumb. You should wait until after earnings." So they could be right. And I've got money set aside for that too. Because of Matterport taking off, I've got a little extra money than I had, earlier in the day or yesterday. So that worked out. I actually wish I would have had the strike way lower. Could have made a lot more in returns if I would have done that, or even just holding the stock. I mean, people that held the stock did just about as good as I did, if not better. So, but that was a great opportunity. I hope everybody got to benefit from it. And I think our next play is Tesla. If it keeps dropping, right now it's down about 3% on the day. There's about 3 gaps that get us all the way up past 160, and then there's more gaps after that. So I think there's a lot of opportunity here, guys. I would not want to be just sitting on the sidelines afraid right now. I think that play didn't work out very good last year, and I think that we're going to see that same thing occur this year. We might have taken a pause, but Bitcoin ain't taking a break. Global liquidity ain't taking a break. And again, China's deflating the rest of the economies around the world. Some of that might slow down with tariffs. Both Biden and Trump are trying to figure out who can put out more tariffs. But I think by that time, it'll be a little too late, and it won't have that much of an impact on inflation. So stay strong. Don't get scared away, because I think that would be a mistake. And maybe I'm wrong, but probabilities say I'm probably not. All right, let's look at chat real quick, and then I'll probably bounce to you. Clean Spark to the Moon. 2A Allen, I agree. Ran, the FOMO is effing strong with Tesla right now. I think it will be. I don't think it's there yet, but the FOMO will turn around really quickly tomorrow. If Elon just says a couple of positive things like this is going to increase margins, most likely going to increase margins in the not too distant future, or the Model 2 isn't dead, and or any combination of words, he can turn things around, and he usually does that at the appropriate time. Whether that time is now or whether it's next quarter, I don't know. I don't really care. I'll be buying the whole way down. And I'm going to be making plenty of money off of Bitcoin-related investments, well over $1 million in those. And I have no doubt, today it's probably even more, but I have no doubt that they'll turn out well and that I'll have opportunities to buy all the other favorite things that I own. All right, real quick. Dustin, P11. Sweet, thank you. Such a good information. Scooped up a couple of Tesla calls Friday at market open. Good luck to everyone. George Manassas. I believe if we have strong guidance on earnings calls and good PCE, we rip. I agree. I think earnings are going to be good for big tech at least, especially like companies like Meta, like Holy Smokas was saying, Jeremy from yesterday's video that I reacted to. I think that Meta's going to do really well. I think Google could start doing better based upon advertising dollars in an election year. I don't think we've ever seen the kind of advertising from an election that we're going to see this year. Heck, the Chinese and Russians might even be paying for some of it. Who knows? All right. David. Oh, I thought it was going to be Portnoy. It's Parketsney. I've got this font too small. I need to turn it up. Tomorrow, Tesla will drop even further. That's the time to buy. That's what everybody tells me. Hey, man, I don't know. Personally, I don't always follow the herd to find the perfect bottom. That just statistically hasn't turned out well for me. But that seems to be everybody's game plan. Wait for tomorrow and then buy. So we'll see how that goes. Not that it can't work out that way, but probabilities, I think, are against it when the herd is thinking that. All right, Dustin P11, holy smokes, I did not see Matter till now. Yeah, it's done pretty good. Ran, my personal FOMO, that is. Kevin, hands up, hands up. All right, Johnny Salgado, Jesse, December 2026, 3:30 calls for Tesla. What do you think? I think they might be a better value now. They weren't that great of a deal a couple weeks ago when somebody asked me last. But if Tesla keeps dropping, like I might even think about, I don't know if I'll pick the exact same strike. Maybe, but I might even start thinking about that December 2026. If we get a big drop tomorrow, maybe that's what I end up buying. That way I can stagger out, some of my risk. Anyway, I think that's it for now. I will see you guys in a couple of hours here in the market recap at 3 p.m. And again, if you want to be able to see some of the data behind why the Fed needs to raise rates this year or lower rates this year, come to the market recap and don't miss it. Otherwise, I will see you guys tomorrow for sure. Hopefully, you'll be coming to the Tesla earnings. So we'll be doing the market recap, but we'll be doing the market recap in between Tesla posting their earnings and then the call. So we'll fit that stuff in between with a focus on Tesla. All right, you guys take it easy. I will talk to you later. Have a good one.